Based on what my friends think, Chipotle is the best fast food restaurant in the entire world. There are stories about people driving 500 miles just to get their Chipotle. And one of my friends even said that Chipotle factors into his travel decisions. So let's go see what all the fuss is about and whether Chipotle is a good investment for us. If you're new, welcome to my channel. My videos are about investments that anyone in the world can make. Chipotle is a Mexican burrito fast food restaurant based mostly in the USA, but they also have stores in Canada, the UK, Germany, and France. Now, there is no shortage of competition in the fast food industry, with McDonald's and Subway and KFC and Burger King. So how did Chipotle manage to stand out? The story begins in 1993 when Steve Ellis founded the first Chipotle in Denver, Colorado. Steve borrowed $85,000 from his dad, and he worked out that he needed to sell 107 burritos per day to make some profit. But by the end of the first month, he was selling 1,000 burritos per day. This is an amazing and rare story of immediate business success. So obviously the burritos taste really good. By 1998, Steve had expanded his Chipotle restaurants to 16 different locations. Now this is when McDonald's stepped in and took a small ownership of the company. And with McDonald's help, Chipotle was able to grow to 500 locations across America by 2001. Now what followed was a little bit of a strange move. See, McDonald's actually sold back their shares to Chipotle. The reasons are actually still a little bit unclear, but apparently it was because McDonald's wanted to just focus in on McDonald's and not have all these other little side projects going on. And by 2017, Chipotle had reached 2,400 locations in 5 different countries. They had a big issue in 2015 with a serious E. coli outbreak that originated in Chipotle stores, and the share price tanked. And you can see the dramatic fall recently as well. But besides this, the business has been very stable and very popular. It is 5th favorite overall in America and far stronger than its Mexican chain rival, Taco Bell. The future of the fast food industry is a little bit questionable, with people wanting more healthier options. But at the same time, people are inherently lazy, and I really don't think people are going to start cooking at home all the time more than they go out to get fast food. And I think fast food is still going to be a very important part of our society. Chipotle have actually only expanded to 4 countries outside of the USA, so I see that as a really big opportunity for growth. Do you even remember when McDonald's and Subway were, say, in just 5 countries? Now they're in pretty much every country, so Chipotle could follow this same path. McDonald's has 38,000 locations, Subway has 41,000 locations, so if Chipotle was to even get, say, half of that at, say, 20,000 locations, well, that's a 7 times increase from where they are now. So in the big picture of things, there's a lot of opportunity for expansion for Chipotle, and the future looks really bright. The industry is going to be around for a long time, and they have a tasty, popular product. But right now, the restaurant industry is suffering quite a lot because of the lockdown. So we're going to have to make sure Chipotle has strong financials so they can get through this period of uncertainty and then be able to expand on the other side. Have you eaten at Chipotle before? Honestly, I haven't, but I'm only going on what my friends think of Chipotle. They love it, but it is just my friends. So if you could leave a comment to tell me whether you love it or hate it, it'd be really helpful for me to know. I also find it fascinating that a fast food restaurant can have such amazing fans. It's not like you hear people raving on about how amazing McDonald's is, so what makes Chipotle so special? On the surface, Chipotle seems like it has a great opportunity to grow throughout the world, but what about its financials? All right, so let's go take a look. And there are 3 key areas that we're going to have to look at. We're going to look at whether they can manage their debt, whether they're growing, and make sure that the management team are making some good decisions. Now, we want to see the company pass all 3 of these criteria, but unfortunately, it is a bit more of an art than it is a science. So it'll take some experience to understand really what we're looking for here and what's good and what's bad. I have general rules about each of these criteria that I've developed by studying Warren Buffett, Bill Ackman, and Benjamin Graham. And please just sit back and don't worry too much about the terminology. If you're just getting a feel for what's going on here, that's great. But if you want to know more about each particular ratio that I'm using, well, go back and look at my Facebook analysis video where I go into far more detail. First, we're going to look at whether they can handle their debt. And this is really important because if the business was to completely stop, let's say for some unknown reason, like the government shut down all restaurants and we had to go back into some serious lockdown again, well, we want to make sure that the business can survive. So to see if a business can handle its debt, I went through the debt to equity ratio first. And for Chipotle, they have actually only just got some debt in 2019. So I'm actually not sure how they've managed their debt in the past. They have an acceptable current ratio, so the short-term debt prior to the crisis was manageable. But we're probably going to have to wait until July to get some more data on how bad the situation has gotten. Chipotle actually would have got a tick from me if they didn't just take out that big heap of debt in 2019. So they are now more vulnerable because they took out this debt in 2019, and because of current events, well, that was just bad timing. Are they growing? Now, of course, we want to invest in a company that is growing, right? But just 1 or 2 years of growth really isn't that convincing. We really want to see long, stable growth over a long period of time. So to check for consistent growth, I look at book value per share, earnings per share, and operating cash. And I found for Chipotle that the E. coli outbreak in 2015-2016 seriously affected their growth. But they have shown signs of recovery since then on all three areas. So although it's not perfect, I can give them a tick. So in my opinion, I think it's actually a good thing that they had this crisis back in 2015 and got through it. A crisis like this really does strengthen up a company for the long term. And they're also going to be more conservative about their decision making in the future as well. So I'm actually totally okay with a bad year in 2016 because we've seen recovery since then, which is a good sign. Is the company well managed? So we obviously can't just go in and sit in on one of the management team's meetings, but there are some telltale signs in the financials that will tell us whether management are making some good decisions. So I check for cash deployed into investing activities for the business, return on equity, free cash flow, and I see if they have a dividend. And I found for Chipotle that besides the E. coli issue, management are doing a good job managing the company for their shareholders. Prior to the E. coli issue, the ROE is very stable, and it looks like it was back to where it needed to be. But obviously the current lockdown will be a little bit like the E. coli issue again, maybe far worse. So the short term will be difficult. There is currently no dividend, but as they mature, I think they will pay out a dividend in the future. Overall, I'm happy with the management at Chipotle for the long term, so they get a tick. So we're going to use my calculator to find the intrinsic value of Chipotle. And if you want a copy of this exact same calculator, it's free in the description below. So let's go straight to it. Now, the growth rate I've used for years 1 to 5 was 16%. Now, the analysts have thought 18%. So 16% is nice and conservative. Then I've used 14% for the next 5 years. 20% is my ROI goal, which is I want 15%, but then a margin of safety. 12 is what I could sell it for. It's the multiple I could sell it for after 10 years. That's quite standard. And then I went and found the operating cash flow minus maintenance capex number, which was 500 million, and the shares outstanding is 28 million. So the price that I'd want to buy it at is $246. Now, if I go down a little bit further, my second buy price would be $205. Now, I've just used more conservative numbers here and a bigger margin of safety. And I think that's probably enough. I have gone further and done a more aggressive buy point, and that goes down to $103. I don't think we have to worry about that one too much because let's go have a look at the share price right now. And if I go check the current share price, it's $995 for Chipotle. Very high. So one day, people are hoping that the stock price where it currently is today is going to look a lot cheaper into the future. See, if the company was to grow at 18%, just like the analysts think, and everything was to go smoothly along the way, well, it'll actually take 5 years for Chipotle to reach its fair value of $1,000. So for the people who are buying shares at the current price, they're actually paying what the company will be worth in 5 years' time. And to me, that doesn't seem like a very good deal at all. And there's just too much hype and popularity around this company. So I think the upside is really minimal, and there's every chance that the share price just does nothing for 5 years. Now, I'll say this, and the share price will definitely now go to $2,000, but I promise it's all speculation making the price move. Now, just because it is all speculation and hype, it doesn't mean that I'd ever short the stock either. It's for the exact same reason I don't buy the stock in the first place. It really could go in either direction. I do think Chipotle have the potential to be up there with McDonald's, but I'm just not going to pay what it's going to be worth in 5 years' time today. There are so many other things to invest in, and we'll find something far better. Now, I've spent about 2 days doing this research, and it is just for entertainment purposes. I'm no expert, so please do your own research and make your own decisions with your own money. So before I go today, I just want to answer one question that keeps coming up in my comments. So the question goes a little bit like this. People ask, the economy is down, but the share market is up. Why is it so disconnected from reality? What's actually happening here? Why is the market so crazily high? And then on the 11th of June, the Dow Jones fell nearly 2,000 points and people were just really unsure what to do. So what do you do in the current market? I try not to be rude when I'm answering this question, but the truth is I just don't care, which definitely surprises people because I'm an investor and my largest investment is in the stock market. And right now I'm training myself not to care, and neither should you. Let me explain. So if you're a passive investor, you should be thinking your time frame is about 40 years. This graph here is the GFC. It was a scary time in the market. People thought the whole world was going to fall apart. Now, let's zoom out. Now let's see what the GFC looks like over a 40-year period. As you can see, it really wasn't that big of a deal anyway. Now this is the Black Monday 1987 crash. I wasn't alive, but it was an insane thing to happen and took years to recover. But again, let's now zoom out. And now you can see that 20% fall in 1987 really is insignificant. So for passive investors, just ignore the media, just keep buying consistently and you'll be completely fine. Now, for value investors like me who are looking to buy undervalued companies, well, again, I don't care what happens to the overall market. I'm really just focusing in on the companies that I want to invest in. See, I decide my buy up to prices for really good companies, and then I just wait, and I wait for the prices to match my buy up to prices, and then I go buy them. If the media is reporting that the market is completely overvalued and there's going to be a bubble pop at any moment now, I don't care, because I'm only interested in my individual company and its value. So let's say I'm looking to buy Berkshire Hathaway at $175. Then the market goes up, say 20%, but Berkshire Hathaway goes down 20%. Well, that's great news for me because I'm only focusing on Berkshire Hathaway. And if the whole market was to go down 40% and Berkshire Hathaway happened to go down 40% with it, well, I'd be delighted because I could buy a lot more. So to answer the question, it's not about what the markets are doing, it's just about what my particular company is doing. Download your free calculator in the link below, hit subscribe if you haven't done so already, and I will see you in the next video.